for those that can't make it. What we know is definitely luck is involved, and there's an underlying, luck outcome. So
Yeah,
then it's
for sure.
really then a question of how do you identify whether it was skill, you know, and that's basically saying that it's so uh, out of range that it's enough to prove that it was skill. So, but that interview with Larry Swedroe, I've already interviewed him once for the podcast, and I'm starting to now. I basically have sent out invitations to about 700 people who have been guests on other strategy podcasts, and I'm starting to get them on. The interview that I did today is um, was with that I just published today was with a guy named Louis Vincent Gav, and we talked about China, we talked about Russia, we talked about a lot of different things. I never listen to my podcast because I just get so listening to your voice and just all that. But for this podcast episode, I definitely listened because I felt like there was a lot in there. Let's welcome Mercy and also Vishan, who are also on now, as we're just getting started, and also Chirapon. Pon, good to see you,
Hey,
and
Andrew. Hey, everyone.
good to hear from you. And Mercy, how are you? And if you see hands waving behind Hui Kun's head, it's because she's got kids in the back, I'm sure, freaking out. So, uh, what I want to do is get started. Hold on one second. So, there's a couple of things I want to talk about. The first thing is that our strategies, our investment strategies, we're going to publish them very, very soon. And it's kind of a pivotal time because we've been overweight commodities, underweight US market, underweight equities for a while. And so now it's really a question of where does that go? Now, the most important thing in disseminating the information is that we disseminate it, equally at the same time. And we do have other clients that we disseminate to also. So I don't want to give any indications of if there's changes or not. But I would just say that watch for the next day or two because we'll be releasing that into the group, and I think it's going to be interesting. I had hoped that we could have released it before today, so I could have talked about it today, but keep your eye on that because I think it's got some interesting stuff there. So, second thing is that I wanted to talk about sectors a little bit. I've been doing some work. Basically, what I'm trying to do now is write a investment strategy made simple episode every week, with the objective being that I share it with you guys as I'm working on it and let you guys see what I'm doing and then have some discussions about it. And then I rush and struggle on Thursday and Friday to get it done and published and out there, which is basically that means every single week. I would say it's probably a total of about 15 hours of my time. Now, what I'm trying to do is make everything that I'm doing into chart books so that in the community, you're going to have access to like 10 chart books. The chart books will be about risk-free rate. The chart books are going to be maybe about equity risk premium. The chart books are going to be about inflation globally in the US. The chart books are going to be about sectors, about countries, and that type of thing. So a lot of what I'm doing is trying to construct that week after week until we've got this great framework that can be updated on a monthly basis, and then it gives a real reference for you guys. So I'm going to talk briefly about the one I'm working on right now, which is sectors. And as I started working on it, I realized that MSCI, which is the main organization that does the sectors, has made some changes that are taking effect in March. So I'll explain a little bit of that. So let me do that now. And I haven't come up with a name for this presentation yet because I haven't really come up with my final conclusions. But the first thing is just to introduce, for those that don't know it, I think most of you guys probably do know about MSCI GICS classifications. And that's what I was saying, there's some changes being made there. So these are the classifications that we use in the world of investing. And now there's no change here. There's 11 sectors. So energy, materials, industrial, consumer discretionary, all the way down to real estate. Now there's 25 industry groups. I think they've increased it from 24. So some sectors, such as industrials, have 3 industry groups as follows, like capital goods or commercial and professional services or transportation. So those are 3 industry groups under one sector. And then let's look at one of those industry groups there, transportation. And there's now 74 industries. Within transportation industry group, there are 5 main industries. So there's air freight, passenger airlines, marine transportation, ground, and transportation infrastructure, like toll roads and things like that. And then under that, there's 163 sub-industries. Finally, within the industrial sector, the transportation industry group, the transportation industry are the following sub-industries: airport services, highways and rail tracks, and marine ports and services. Now, you don't have to know that much about this, but the point is that you want to make sure that whenever you're comparing something, you want to try to compare it within a sector and get it narrowed down. So here we can see that this highest level of GICS sectors includes 1,508 developed companies, developed market companies. So this is US and Japan and the like. It's not emerging. Market capitalization of all these companies comes up to about $53 trillion. And the largest sector is infotech and the smallest is real estate. You can see that there's 183 infotech companies and there's 96 real estate companies. This is due to the number of companies, but also, like, there's more infotech companies, but also the valuations. Now, of course, I always try to focus in on investment strategies and our FDMR framework. And again, we backtest and try to optimize the strategy for the factors that have worked best in each market and each sector. We do all of our research in-house and we don't rely on others. And basically, the benefit of an investment framework is that it forces discipline when emotions run high. And that can be often. Emotions from wild market events can cause you to make rash and costly decisions. To avoid this, try to stick to your framework. Our framework relies on data and structure, not just a feeling or opinion. So for the FVMR, we look at the top, and that's management, which is responsible for producing earnings. And then we have investors at the bottom that are responsible for the price. There's 4 elements to our FVMR framework. The first one is fundamentals. We're looking for strong profitability, which shows the companies manage well, and we prefer high or rising profitability. Of course, valuation shows how the market is perceiving the stock, and we prefer good fundamentals and cheap valuations. For momentum, we try to avoid value traps by looking for positive price and earnings momentum. And at times, low momentum can signal an out of favor opportunity. And finally, we prefer low business and price risk. Not every stock is going to fly. Some just provide stable returns and strong dividend. So for this study, I looked at the major sectors that we looked at earlier. And basically, if we look at fundamentals first, here is the various sectors and their 2023 return on equity estimates that are consensus estimates. What we can see is 23% ROE is pretty massive for telecom, but it's high for healthcare, consumer staples, and energy. And it's pretty low, lowest being real estate. So here we can see when we look at net margin, that was ROE, this is net margin. Telecoms also is a leader at 16%, and this current market average net margin of 10% is still much higher than the long-term average of about 6%. Now, a lot of industries are below the average. I would say tech in particular, and real estate on the net margin front have kept this up. So I'm going to skip ahead to this one. Let's look at valuation for a moment to understand. I keep them in the same order of size from infotech to real estate. And here we can see that the highest PEs are for infotech at 24.1 times. And financials and energy are cheapest at 11 and 8 times. Usually, when ROE and profitability is high, energy trades at a low PE. So let's go back and look at the energy sector. From a net margin perspective, 8%, but from an ROE perspective, 20%. So for the equity investor, they're getting a 20% return, which tells you it's pretty good times for energy. And that's part of the reason why when earnings are high, you see that PE is low. And because they're a cyclical company industry, they're going up and down. That oftentimes when the market's cheap, when the energy sector is cheap, is the time to sell, not buy. Now, financials are at 10.7 times, and I would say that they never get expensive because there's a lot of financial risk in there. So 7 is kind of a little bit high, but not overly expensive. Now, Infotech is pretty crazy expensive at 5.4 times price to book. That's followed by staples and then healthcare. But we have a lot of sectors that, financials at 1.2. That means that basically only 0.2 times, right? Only 20% of above the market value or the historical book value is what the financials are trading on. Now, it's also important to understand that financials tend to mark to market. So that means that their balance sheet is a lot more market based than historic based like other companies. So when it's marked to market like that, you tend to have a price to book that's closer to 1, as we can see right here. So I would say that the financial sector can get up to maybe 2 times, but generally it's not going to get higher than 2 times price to book. So I would say it's moderately cheap right now for financial. Now also notice that I did a calculation where I excluded the infotech sector, and you can see that excluding infotech, the market's trading at 2.5. I just want to go back for a second and look at the PE. Here we can see the market's trading on 18 times PE and 16 times if we strip out the expensive tech sector. Let's look at some chart I just put in here. This is trying to understand why this 5.1 or 5.4 is there. So that's super high. Now, a lot of people say it's because the tech companies don't have a lot of fixed assets, and therefore the price to book is not a good measure. So I wanted to look at that and see what made sense here. And here's what I found. The typical US company has fixed assets as a percent of total assets. And I excluded cash from total assets to kind of take away the extremely high cash levels that tech has. To just look at the pure balance sheet. And what we can see is that fixed assets as a percent of total assets, excluding cash, is now about 30%. But for tech companies, it's down at about, let's say, 15 to 17%. So it is true that there's a lot less fixed assets. Now that has changed over time, and I think that eventually fixed assets will rise more for infotech companies because as they have to build out server farms and other hardware structures to build their business. But for right now, it partially explains why it trades at a high 5.4 times price to book. Now, price to cash flow, we can see, is about 17.4 times for infotech and all the way down to 4.6 times for consumer services, communication services, meaning telecom, which is quite low. And then dividend yield, we can see, is very low for infotech because prices are high, and it's high for financials and energy, as well as materials and utilities and real estate. So this can give you a picture either, number one, if you look at dividend yield and it's low, it tends to mean that the market's expensive because dividend yield is dividend divided by price. If the price has gone up a lot, but the dividend hasn't changed, then you're going to see a lower and lower dividend yield. But if the price hasn't gone up that much or it's gone down, we can oftentimes see dividend yields at 3 or 4 times or 4%. Now, if we look at ROE divided by price to book, we can see that higher is cheaper. So energy looks the best. Financials is second best. Remember that the ROE for financials, the price to book was 1.2. So the ROE is about 11% roughly. And that means for every 1 in price to book that you're paying, you're getting 9 in ROE. So financials look interesting to me here, for sure. So let's now look at what's happening with 2023 revenue growth expectation. On average, it comes out to about 2%. That's not particularly good. And I would say that materials is expected to come down, as well as energy, and consumer discretionary is coming up. As far as earnings growth is concerned, it's the financials, consumer discretionary, and utilities that are getting that growth for 2023. Now let's look at price change. What we can see is there's almost no price change for the overall market over the past 6 months, but we have seen rises in healthcare and a collapse in real estate. And I think part of that obviously is as mortgage rates are rising, people are worried about the real estate market. That's bringing down real estate companies. As far as 3-year price change, we can see the average price change has been 13.4%. Now, I didn't back out Infotech, and maybe I should in this case, which was up 32%, and we know has a high weighting in the industry analysis. Therefore, instead of 13.4, maybe we would have had an average annual return of maybe 9. We can also see energies and materials have done very well, which tells us maybe that it's time to get out of those at this point. So that wraps up the work I've been doing on it. I haven't come up to my final conclusions for everything, but it gives you an idea of kind of what's going on and what I'm looking at. So let me ask, are there any questions or any comments? Or was it boring?
No, I was thinking of something. Basically, I actually want to have your opinion on the financial aspect because I see in your FEMR, I think you rarely have a financial institute like a bank in that. But I'm thinking about this one, Bank of China, because I think I look at the basis, I think it's very strong and dividend is very good, 8%. So what is your view on that, on the Chinese bank?
There's kind of pros and cons, though, because it's state owned. I would say that you just never know what they're going to do with non-performing loans and whether they're going to have to follow the government and take over bad performing loans, and then shareholders have to absorb that. And that's one of the reasons why people are hesitant to get into it, because they're fearful that it's like an arm of the government. But at an 8% dividend yield, which I haven't looked at its yield, I would say even if the share price fell and it went to a, well, actually at 8%, I would say it's not bad. I guess my concern about China right now is just that the growing trade war, I think it's just going to get worse. And so that may not affect, the thing about the financials is that it's definitely domestic economy, right? So if there's a domestic recovery, it should do well. So I wouldn't have a big problem with it. I would just say that don't make it a big part of your portfolio because of some of the risks related to the market. Also, I would suggest a 20 to 30% stop loss for the Chinese market, because it can get very volatile. So for our China A shares portfolio, which we've been doing since 2016, I would say 50% of our performance is stop loss, preventing the stop loss from, preventing ourselves from losing a lot. So, and by the way, for FVMR, we don't include financials. Which I'm going to tell you more about that in just 1 second. Hold on. You got no more exercise. All you got to do is get over to the table and have some dinner, have a glass of wine, and relax, right, Gig? Okay, that's my duty. So basically, we generally don't invest in financials. And the reason is because they're government controlled now, even in the US, they have to follow everything the government says. And so, you know, it's become like an arm of the government. Hold on 1 second. Get watch her carefully. She so I don't like banks because number one, they're arms of the government now. Number two is that they're a commodity business. If one comes up with an idea like a certain type of credit card or something like that, the other ones copy it very fast. And also, they tend to be a representation of the market. So a bank is lending to all the companies in the economy. So the bank can be a way of getting access to the domestic economy that's not traded in the stock market because they're lending to them. But the bank doesn't necessarily get all that upside. But the point is that if I was investing in banks, I would just either buy a bank ETF or just pick 3 banks and say, that's my bank exposure. I would look at it more like sector exposure rather than stock portfolio exposure. The other reason I didn't mention about banks is because the probability that a bank could become a 10 bagger and go up by 10 times, it almost doesn't exist because of all of these factors that I mentioned. But when you look at, I don't know, let's just say a snack company, a consumer company, a tech company that gets a hit product, they can go up by 10 times. It can happen, you know, because it's like pure entrepreneurship. So those are some of the thinking that I've got on the bank sector.
All right, but I just say the dividend 7 to 8% is very good.
Well, I would say if you're going to do it, just put a small amount in your portfolio.
Okay.
All right. Other questions or anything you guys want to talk about?
So what do you think is going to be like the best performing sector?
That's a good question. That's the question I haven't figured out, Moment.
I was like thinking since we started this presentation, so what is going to be the best one, you know? And what other sector you hate other than financials, and why?
Yeah, it's not so much that I hate financials. It's just that I just don't see the opportunity to make a lot of gains. But let's go back and look at it.
Yeah.
ESG.
Yeah, ESG. I got to show you an email I sent out today. Hold on, I got to get this. I think this is one of my best emails. Hold on, let me get this email. It reminded me of that.
You
Hold
hate
on.
that, I know that.
It's a scam.
You might not hate the financials, but I know you hate ESG.
Yeah.
To the point.
Oh man, I'm trying to find this email I sent out. Hold on. I just thought it was a good one. I can't find it. But anyways, somebody sent me a message inviting me to an ESG conference. And I wrote back and I said, I just recently wrote a piece called 26 Reasons Why I'm Anti-ESG. Maybe we could have a debate at your conference. Pick your top person. I know, they're not gonna, they won't debate. Let's see. I'm gonna get that debate someday.
I would pay to watch that debate, Andrew.
I'm gonna go to you guys when it's time to prepare for it, and I've got about 5 different guys that I'm gonna go to also, and I'm gonna construct the best arguments, and I think I can really knock it out of the park with that.
I'm paying for this.
Yeah, no, I would love it. Anyways, let's look at where to look. So the challenge of this research, because I'm setting up my structure to build the chart books, there's only so much I can do each week. So this is at a point in time, it's not overtime. And therefore, the result is that we can't see the trends of what's been happening here. But I would say that financials, if I had to allocate to sectors, I would say financials probably will do okay. Particularly, I think the U.S. financials are super strong with like 30% of their balance sheets in risk-free assets, basically government bonds and cash. So I would say one sector that I would say could move is financials, and I wouldn't buy an individual stock. I would just buy the sector. I wouldn't buy consumer discretionary right now because I think we're going into a potential recession. The risk of a recession is high. So that would be one I would be probably less excited about. Now let's look at the PE ratios. So I would say that it's possible telecoms has further to go down on D rating, but it's hard to say that telecoms is going to become like super cheap because they just have so much cash. If I look at energy, what we've seen is that ROEs have been quite high, but if oil prices stay low, as they have, then there's not going to be any big change to that PE. And as far as financials, I'd say there's still some upside probably in that PE ratio. And it could be time to go, back into consumer staples if you think that we've got a recession coming in the U.S. So I guess those are some of my thoughts on it, Moment. But I have to admit that this is the final step of this research here, is to try to draw my conclusions, and I haven't got super strong ones yet, but I will by tomorrow morning.
Yeah, I'm gonna wait.
And any observations from you guys or something that you think looks interesting?
Andrew, just a question here, or more like a discussion point. Sorry for the ambient noise from outside. Do you think input tech can sustain such high valuations over the long term? I mean, yeah, like I know there is a lot of innovation happening. There's a lot of startups and stuff, but on a sustainable level for the long term, what do you think?
You're talking about infotech?
Yes, as a sector,
Yeah.
yes.
I would say that that it's getting harder for infotech companies. I think that it's getting harder to get ad revenue. It's harder to get people's attention, which is what a lot of them are doing. And so, and I also think that there's going to be regulatory pressures on, particularly, let's say, the social media companies and YouTube and the like. And so I think that that is kind of a downdraft for them. But as a sector, it's hard to see that it's. I mean, I would think that the sector is still going to do pretty well with all the new products, tech, all the within the tech infotech sector is, semiconductors and the like. So it's software and hardware, and so I would take a relatively positive view on the sector, but from a price performance perspective, I would say maybe it's 3 to 6 months from now before I would get into the sector.
Mm. Yeah, I mean, it also really differs by region, right? For infotech, by region, by companies. Yeah.
Yeah, and
Okay.
the tech sector that I was showing, all those sectors are only developed markets. So it doesn't include Taiwan, Korea, you know, China and things like that. And so there's a lot of tech there that's very different in nature, not high end. But I think the US with its software, I think will always have a dominant position. All right, what about
Interesting.
others? Any other thoughts or questions or things that you want to discuss or things that you want me to do some research on?
What is your view on Vietnam?
As of right now, I'm still, it's funny, I get that question all the time. As of right now, I give my same answer. I turn all my questions about Vietnam over to Amit.
Me?
Actually, we have Phu Decha also, who's in the group, who's not here today, but he's also really good about Vietnam.
Yeah, he's the analyst there.
Yeah, I was just at an event for CFA talking with uh, a guy from NT Asset, an analyst in Thailand who's been at Vietnam quite a bit, and then also a Vietnam fund manager, Pasawut, who works at InvestX. And we were just talking about Vietnam. The the analyst was pretty positive, but Pasawut was still pretty negative. Like there's still more political stuff happening and other issues that he was concerned about. But I would say Vietnam's been out of our FBMR methodologies for a while. So I was expecting that it would come back in. So if you see tomorrow or the next day when we release the things, if Vietnam is in there, that's a sign that we think it's attractive now. If it's not in there, then that's a sign that nope, still not attractive. I'm in.
So I want to know one thing. What's the reason that everyone is talking about Vietnam right now?
I think that they see a lot of growth, and for Thais, maybe they don't see as much growth in the Thai market.
So it's like a Thailand 2.0?
Yeah, and I think there's a lot of people that feel like they're frontier investors and it's an uncovered opportunity. They can get in now. You know, it's also a very narrow trade, right? Like the amount of volume in the market is tiny. So if it goes up quite a bit. But I can't say, I mean, you could argue that it's got a bigger population than Thailand, it's got more productivity than Thailand, it's got more potential. Just look at the great example is Thailand had a major head start on Vietnam when it came to coffee growing. They both have highlands to produce coffee, good quality coffee they could sell to the world. And Thailand is nowhere to be seen. And Vietnam is now the second largest supplier of coffee in the world. So it's that type of, push to improve and expand. I think that people see in the Vietnamese that they may not see as much in the Thais these days.
So maybe like when you came in the 90s, so can you say the Vietnam is the 90s of Thailand?
Yeah. The difference was that, the political system was so different. You still are kind of got the strongman, communist style political system in Vietnam. And we never had that. When I came in to Thailand in 1992, we had just had the protests, the May 1992 protests over, I think it was Suchinda, the general at the time, and the king had, stepped in to calm things down. But in Vietnam, just look at the reaction during COVID time. I mean, they have machine gun guys with military guys blocking off every quadrant of the city in Ho Chi Minh City and blocking off the whole country in a very, very authoritative way that Thailand's never going to have. And that kind of level of I wouldn't necessarily call it democracy or freedom, but I would just say that level of,
Stability.
yeah, it's stability, but it's also laissez-faire. Politicians are not going to put a heavy weight on the people of Thailand, or else they just know it's just not going to work. And
But it's
that's,
working in Vietnam.
yeah, yeah. People will follow that. And I think anywhere, unfortunately, people, one of the lessons that you can learn from the COVID time too is that people will follow whatever the government said, right or wrong. Once other people are doing it, they'll feel like they've got to do it too.
I think it's a demographic also.
Yeah, demographics are in their favor for sure. Young,
Yeah.
healthy, growing, 90 million or so opportunity. I think the other thing is China, with the China and US trade
Yeah, China
problems.
plus one.
Yeah, and Thailand, it's a super tight labor market now. Trying to get good people is so hard in Thailand. And there's Mercy, by the way. Let's welcome her. Just recently graduated from the Valuation Masterclass Boot Camp in Nigeria. You think it's hard in Thailand, you think it's hard in Vietnam. It is damn hard for the people of Nigeria, thanks to not very helpful politicians.
We had in our boot camp, we had from Ukraine also during the war.
Yep.
Remember,
Study.
Moment?
Yeah. We had Christina.
Yes,
Yep.
Christina, yes.
Yep.
From Ukraine during the war, yes.
Yeah, I guess there is like election now in Nigeria, and like people having some troubles there.
Yeah, Mercy, why don't you update us? How are things right now?
Look, before she talks, elections here in Egypt, just the president wins before the election starts.
He won before the
They
election
just
started.
yeah.
No need to
The
have an election.
homemade election. Yeah. Homemade elections.
Yeah. All right, Mercy.
Soon going to be like this. Soon Turkey is going to be like this.
Mercy.
Yes, it was last Saturday that we conducted the election for presidential position. And it was tough because many people were interested, and a lot of competition, and the issue of, there are a lot of issues as well. Most people's expectations were not fulfilled because of the lack of uploading the results on time, so that people could view the winner and the people that did not win.
So do people think that the winner was that the winner may have cheated to get to that position?
In competition, some will be in anything like elections, some will be supporting the winner, whilst others might not be supporting the winner. So some are supporting the winners and others are not supporting winners.
And so has the final election results been announced now?
The result is out. The final result is out.
Okay. Well,
Sorry. Are you happy with the result?
I didn't get you.
are you happy with the
happy with-
result?
I am not.
We can see that.
Yeah.
I am not
Yeah.
happy.
Look,
so-
I remember last time I went to vote the elections here for the president. There was like two two people volunteering to be the upcoming president and so on, and both of them were awful, you know. So I went there. It is like a paper with their names in it, and you just take on the one you're gonna choose. So I wrote my name, and then I just ticked on my name. So I believe I'm gonna be the upcoming president.
Yeah.
Then I got
Moment
back home,
brotherhood.
and that's it.
Moment brotherhood.
Yeah.
All right. And Pon, how are you? What are you doing? What's going on with you?
Oh, I'm good, Andrew. And actually, I haven't um, invested in foreign market yet. I focus on in Thai market. So currently, I think because of the lower EPS in Q4, then many stocks decline. But my stocks, the stock that I already bought, have a good performance in last quarter. So I'm still green. My port is
Okay.
still green. But
That's good.
I have a question regarding your presented information. Do you have the data exclusively for the Thailand? I mean, for the Thai market sector. I mean.
I think I do. I'm gonna have to check. That's part of what I'll be building into this booklet, but I can only do so much at a time. But I think I have Thailand MSCI.
Because I currently not start to invest abroad yet. So
Yeah, and it's one of the most frustrating things about the research I'm doing on a weekly basis is you only have a week to do it, so I can't do all that I want to do. So that's a little bit frustrating, but I will have it hopefully coming soon. All right, and Hui Kun, how are you? Anything you want to share, or Jordan, or
No, for this week.
all right, Jordan, how are you? And my Thai reading's kind of bad, but is that oi or what? What is?
Hi. I'll be a silent observer today.
Okay, no problem,
Thank
no
you.
problem. Yep, okay. All right. If there's no other questions or other items, then we'll finish up this meeting now, and then I'll work on finishing up this research and then releasing it to the group first, where you can see it on video first before we release it to the public, and then look for the change in the portfolio coming. Yep. And Ty, can we talk for a couple minutes afterwards?
Thank you very much.
Yeah, sure.
Yep.
Sure.
All right.